Hello and welcome to the Mutual Fund Show. I'm Yad Shah, and over the next 20-25 minutes, we'll talk about a particular aspect, in fact, 2 or 3 aspects of mutual funds. But in the second half of the show, we'll talk about some of the best mid-cap funds to invest into. A lot of you have gotten messages about a particular scheme from SBI, which promises you 13-14% returns. I found it baffling, and therefore we requested the advisor will join later on in the show to talk about that and the possibilities thereof. I know that if I ask Radhika about that, our guest on the show right now, she'll laugh at it as well. But having said that, I won't ask Radhika about that. The conversation with Radhika Gupta, needs no introduction, Lee joins us today, is about a particular kind of fund that Edelweiss has. Maybe they've re-Christianed it, but the idea is to try and talk about that particular product and the opportunity that the product represents around us, and which is IPOs. And she joins us right now. Radhika, I hope all is safe. So good having you. It's been a while.
Yes, it's been a long time. So hope you and your viewers are all safe and well.
Yeah, thanks, Radhika. Touch wood, all okay. Let's talk about this, Radhika. I mean, it's an interesting time to be talking about a primarily or a predominantly or a totally IPO-driven product at a time when everybody's talking about taking a bit of a risk off the table.
So I think,
what is this about? What is this product about? Tell us about this.
I didn't predict that the old fund would close and open at this time, but I think it is an interesting time to talk about the IPO market. Now, we're having this conversation, Neeraj, probably 5 IPOs are happening or in the middle. So there is sort of IPO mania going on. And that's not the reason this fund is being launched. It's an old idea. I think IPO investing is significant, but it's not significant because of the narrative you see in the market, which is a cool IPO is coming, let's get listing day gains, buy on leverage and exit it. I think IPO investing is not that. IPOs are any other company, and IPO is an event in the life of the company. But what the IPO investing opportunity represents is something that your traditional equity funds, and I run a traditional equity business, does not represent, because these are new generation sectors and companies that are coming to the market. So whereas you have traditional financial services, which is your banks and NBFCs, your new listings that are coming to the market are your depositories, your RTAs, your asset management companies. Whereas you have traditional IT services, you have a lot of fintech companies, you have a lot of aggregators, e-commerce companies coming to the market, you have gaming. So for every old age sector that is represented in the mainstream funds and indices, there is a new age sector that is coming to the market via listing. If I was sitting in the US, this would probably be a less exciting opportunity. But in India, where even your largest exchange is yet to list today, new listings are fundamentally a very exciting opportunity. And the reason to package it into a fund is because if you look at a traditional multi-cap fund, it probably has only 5 to 7% exposure to IPOs. I think the average number is 8 to 9%. So in your traditional portfolios, you don't have exposure to these new gen companies, which is why as a diversification instrument, this makes a lot of sense. And it's taking the 3 core problems of IPO investing, which we can talk about in detail: access, selection, and holding on, and trying to solve them in a fund format.
Neeraj, so let's talk about these, Radhika. Then I have a few other questions as well, but let's talk about the things that this product tries to address, because a normal question that would come to somebody's mind is that why is it that a special fund is needed for something like this, wherein if a company after listing is good, it can be taken into virtually any fund?
So I think the simple answer to that is it can be taken into any fund. It is not taken into any fund, and the data suggests that, right? The average exposure to this basket of recently 100 listed IPOs is 8 to 9% in a traditional fund. And it's not because a traditional fund doesn't want to take exposure. The reality of life is a large cap fund or a mid cap fund is going to mirror very closely, or at least be indicatively following the existing benchmarks. And these companies don't find their way into those benchmarks. These are largely mid and small cap companies, with the exception of select issues. So to invest in them, you do need a dedicated vehicle. They are not, and they will not be represented in a meaningful quantum in traditional funds. There is also, I would say, a different level of diligence that is involved when doing investing in IPOs versus traditional companies, because these are companies just coming into market. They don't have the earnings track record and history. So the way we manage this is a little different from the management of traditional funds.
Okay, can you talk a bit about that? I mean, I think some of the obvious questions, and then of course I would want you to talk about some of the 3 points that you spoke about in detail as well. But just before that, Radhika, how would this be different? So would this mean that hypothetically, that if the fund size and tell us about it, because everybody would love to know about this. That if there's a product which is yours, or maybe there could be other products that could come about, that this would have a finite number of companies, and if indeed there are newer attractive IPOs coming in, then maybe they would have to compulsorily move out of some of the holdings in order to accommodate the others. How does this function?
So this is a limited capacity idea. This is a 500 crore fund because this was an old fund, Edelweiss Maiden Opportunities Fund, that is converting into Edelweiss recently listed IPO fund. It is not an infinite capacity fund because, as you said, its universe is the recently listed IPO market. We intend to close this fund at somewhere between 1,000 to 1,200 crores. I'm probably one of the few asset managers coming on a channel and saying this even before the fund is open. So it is a limited capacity idea, one. Secondly, it will invest in a basket of 30 to 40 IPOs. It's benchmarked to the new NSE India IPO index, which means 80% of it has to be the last 100 IPOs. That is a pretty wide universe, actually. That gives you a couple of years of IPO history. You have this little flexibility of 20% just so that if something goes from 100 to 102, you don't have to exit it and you don't have a large amount of churn. And the idea is that you bucket companies into either sort of secular compounding stories or cyclical stories. You take larger weights in secular compounders, smaller weights in cyclical companies, and you hold about 4% per company in this 30 to 40 stock portfolio after doing all your due diligence in the company. So that's broadly how this idea is constructed.
Okay. Radhika, is there, when you have a product like this, is there a sense or a target in mind about what's the anticipated return that a product like this could give out? Because when we put this teaser out, right, about this thing, and on my personal Twitter account and Instagram, so some people were talking about how the riskometer rating for this is not very low, or in fact is high. So what are the returns? What are the risks associated with investing in a product like this, according to you, and something that the investor should also keep in mind? Because I've always heard you talk about risks upfront about your products.
So this is a thematic idea, and it is, I think, and we've run it for 3 years, right, Neeraj? It's not a new product. So I can quote data from the past 3 years of experience. This has the kind of risk you should associate with a mid and small cap fund. It was formally benchmarked to the multi-cap index, I think maybe mid and small cap. So the average portfolio composition usually is about 60% mid and small cap, the balance large cap, because you do have some IPOs. Its volatility, therefore, is similar to those kind of funds. Its return profile, it's very, very difficult to predict return profile in anything. But I think you should see multi-cap plus kind of returns. I think the last 3 years, its track record as a closed-ended fund has been exemplary, of course. And that was an average IPO season. I think 2018 to 21 were average for IPOs. So I think we are optimistic about the road ahead. But please remember, this is not a core portfolio. It's my fund, but I will never say it's a core portfolio holding for anyone. It is a satellite or thematic idea. But if you're looking to get access to IPOs, I think the one thing a fund vehicle can do, which an individual can't do, is we can participate as anchors, we can participate as qualified institutional buyers, and we can also participate after listing. This is something that is unique to a fund format, because these days everyone's asking, what can a fund do that an individual can't do? In the case of IPO investing, there's definitely something that the fund brings to the table.
Yeah. Just one small question, and I'm guessing, while I know the answer, or I think I know the answer, I would love to hear it from you. Would this fund be constrained from investing into, let's say, a company which recharts its growth path suddenly, either makes a discovery or a management change or a corporate action, and you can see in front of your eyes that this company will do really well, but it's not a recent listing, and therefore would this fund have that constraint of not being able to, or have you kept some leeways for extraordinary opportunities?
So I'll give you the technical answer and the practical answer. The technical answer is that 80% of the universe is recently listed IPOs. So there is a 20% flexibility. The practical answer, which I think you already know, is that Edelweiss, we have believed in running funds true to label. If it is a fund where people are coming in for recently listed IPO exposure, that's what we will do. It could be top 100. Could you go to the 105th or 110th IPO? Yes, you could. But would you hold Page Industries, which IPO'd in 2007 or 8, or HDFC Bank? Because everything was an IPO company once upon a time. I don't think that would be right to the investors. So at the risk of skipping opportunities, we also have to be true to what the mandate of the fund is.
Okay. Radhika, one last question. What are you guys at Edelweiss telling investors currently at these levels? Staying invested is probably an all-weather answer, but is there tactical merit? Is there tactical merit in trying to be a bit cautious at these levels? What's the equity advice to investors from your house?
I would tell you this. I think markets are healthy but precarious, and it is a time to be calm and quality focused. I always joke that, Neeraj, when markets are at all-time high, caution unfortunately goes to all-time low. And this is the time when most mistakes are made. So keep a tight eye on quality. I mean, if things are expensive, at least focus on things that are more quality oriented in nature. Never forget your asset allocation and stretch the limits of asset allocation. And finally, do what makes sense for you. Just because everybody else is talking about some asset class or something else, don't push yourself on that. So be cautious in how you think.
Okay, cool. Radhika, it was lovely talking to you about this re-Christian product, so to say, and one of its kind, really. So pretty much no competitors or no peers out there to compare it to as well. But keep up the good work and all the best. And thanks so much for speaking to us. But you should come more often, Radhika. We speak at very long intervals. We should try and change that.
That is entirely at your mercy. So I'm always there.
Okay, sounds good, Radhika. See you soon. Thank you for joining in today.
Thanks, Neeraj. Good talking to you.
Likewise. All right, that's the view from Radhika Gupta. Now, viewers, like I said at the start of the show, that while we'll be talking about this IPO opportunities product, it's actually a pretty unique product that Edelweiss has, and we would request our guest who will now join us, Shalini Dhawan, to talk about that in particular. But what we'll also request Shalini Dhawan to talk about is about two very important and interesting pointers. One of them is a message that has really floated around multiple groups, and everybody's wondering as to how is it that this kind of returns can come in. We'll ask Shalini whether it's even remotely possible. And then, of course, talk about what everybody's favorite topic is currently, the mid-cap space and what are the funds to invest in. But Shalini, great having you. I hope all is safe.
Thank you. Yes. Hope the same at your end.
Yes, all good. Touch with Shalini. Now, Shalini, before we venture into the two key topics that we wanted to talk about, I was wondering if you had a look at, or I know that you had a look at this product because we requested you to. What is your true and fair opinion about a product like this, an IPO opportunities fund?
So I think per se, when one looks at it from an investor's perspective, it is an interesting theme or an idea to think of. And then one does understand that, the fund house has had about a 3-year horizon that they have been, handling this fund in the maiden opportunities close-ended format. And they're now going to make it an open-ended scheme. I think from an investor's perspective, one has to, say that if the investor is looking at, IPO investing as something that he or she is looking at or comfortable with, then this would be, a scheme or a fund to look at. Of course, there are a lot of, risks that the investor should be very careful about. One being that usually IPO investors are, doing their own reading or research and so on, and probably, are investing maybe in IPOs without maybe a lot of either advisor or professional help. So this kind of scheme actually gives them like some kind of professional fund manager research and guidance in that scheme. So all that they need to do is really come and put some money into the IPO fund and essentially get the flavor or the kind of participation in returns of the scheme. So they don't have to do a lot of that guessing or groundwork or checking around with friends and family, etc., or their own research. So that's one benefit that the scheme gets to them. The concern on this kind of scheme is in cases where, because the universe is an IPO universe, there will always be restrictions about either the scheme or the stock selection being a mid cap stock or a small cap stock or even a micro cap stock for that matter. And not all IPO stocks have really are really worth investing in that sense. And therefore, when a particular fund house is doing, of course, their due diligence and research and still getting into that stock, it's about how that IPO performs. And there could be a case where a mid cap stock becomes a small or a small becomes a micro. And as an investor, you do not have much say except for exiting that scheme if you had to. So that's one of the risks. And the other risk, which of course right now we aren't fathoming or thinking about, is what happens when the IPOs dry up, or what happens in a bearish scenario when you have not too much choice in analyzing which IPOs to go for. So then what does happen of an open-ended scheme like this? I think on one side, we do have a good performance by a closed-ended scheme, which is now becoming an open-ended. But on the other side, there are some risks. So I think investors need to kind of weigh both these items.
Have you recommended this, or would you look to recommend this to any of your clients, Shalini?
I think I would, but to someone who is fairly savvy and probably something like someone who understands either a thematic product or is having the appetite for a small micro cap kind of fund, and also a longish horizon, because a lot of IPO investors have a listing gain mindset ki when listing happens I will come out. But what we have seen is that it's not so that all IPOs will actually give listing gains. So we also need to understand that this money is going to a business, right, as an IPO, and then business would need like a 3-5 year horizon to actually show their kind of business performance. So I think someone who's having a bit long term horizon, a little bit of risk appetite, and not someone who is definitely not someone who is only used to investing in maybe very diversified large cap kind of scheme. So that's the matching that one would have to do.
Got it. Okay. Now, Shalini, 2 questions. First one is on this message that floated around about a product. I hate the word guaranteed products, but there was a message floating around. We sent it to you as well about a scheme from State Bank of India's side, SBI Mutual Fund side, or SBSI, which guaranteed 13-14% returns, regular dividend payouts, etc. It's a ghost of the past that kind of returned to haunt. Because so many people tend to, how do I say, quote unquote, fall for guaranteed returns which are very high. What are the most obvious things or signs that people should keep in mind when they see something like this?
I think like the old adage goes that when something is too good to be true, it normally is. So that's one thing. I think that again, like all investors would understand, there's nothing called guaranteed in today's market except for a few government guaranteed schemes as such. But yeah, I mean, a little bit of deep dive into these messages that have come, or the fund in particular that we are talking about.
SBI Special Situation Fund, which is a high yield secure credit fund, just for the benefit of viewers, Shalini.
Right. So essentially, just to understand high yield and also secured and credit. So I think the most important item that an investor is focusing on is high yield, but I think they have to focus on the credit part, the credit risk part. So I think what's happening here is that this fund is actually going to identify 7 or 8 companies or projects, and the entire 750 crores that they envisage to collect is going to be given to these 7 or 8 companies. These projects or companies are unlisted. Okay, so there is one level of risk there. These companies may be going through some cash flow problems, which is how the fund has come into the picture in trying to lend to these companies. So there is a level of risk And definitely, like the messages are saying, that FD kind of investors can look at this. I think FD kind of investors cannot look at this at all, because essentially, the credit risk in this particular investment is very, very high, because you're basically talking about your money going to 7 or 8 projects, and there is a discussion about the IRR of the project being in the range of 20%. It can so be that that project doesn't fructify at all. So, the risk is not, just, okay, not 20, then will it give 18, and not that kind of thing, but just that IRR may not fructify at all, because it is going into a company, and then the company may have its own shares of, hurdles that they will have to face before they can kind of make that IRR and return it to the fund, and then the fund has to return it to the investor. So I think here's where some of the risks lie. One is very high concentration. Second is that, of course, they are saying that the credit they are giving to the company is secured, but the security is in terms of land, in real estate, and also promoter pledge. So, there is again, a shade of many shades of risk here in terms of how and when the monies will continuously flow to the investor. And again, the ticket size again being 1 crore. So what you are doing is you are investing into a fund which is very high risk. It has very high credit risk. You are putting about 1 crore of rupees. Of course, there are stages in which you put the money. So you would need to be maybe a ultra HNI to kind of take this kind of risk appetite, or this kind of leap of minimum ticket size of 1 crore. And also the lock-in of the product is about 7 years or so. So you have to be a savvy investor or a sophisticated investor with a very high risk appetite, and also have to stomach the kind of illiquidity. So there is a long illiquidity in the time frame between, of course, you do get some, and I do understand that currently the scheme is giving a gross IRR of about, I believe 12, 13, 14%, because it's been in existence for about 17 to 19 months. So I won't take away that from the scheme that it has been given. But at the same time, because we are in a very fluid pandemic situation, things can go wrong without much notice. I think it's a credit risk instrument. So I think that's the big concern.
Viewers, keep in mind, so I think, as Shalini said, there is no saying that this fund will not give returns. In all probability, it could. But is it a risk-free return that you're getting? No. Would you want to break your FD or savings account and get into this? Strictly no, because the returns, quite frankly, are not guaranteed. Please keep that at the back of your mind. There's always a risk. In fact, always ask yourself, viewers, to my mind, that if the risk-free rate is X%, which in the current rate could be anywhere between 4 to 7%, depending on what you believe is the risk-free rate, but ideally about 6%. And if somebody is promising 14%, it's not without risk. As simple as that. A point, Shalini, that somebody, or rather most people are now making, is that while small caps are expensive and large caps are expensive, mid caps or the mid cap index is trading at a discount to the small and the large caps, and therefore mid cap funds might be great to buy into. Now, with a hypothesis that mid cap funds are good to buy into, the question to you therefore is, please tell us, to your mind, which are those 1 or 2 good mid cap equity funds that one should get into, and why have you chosen these 1 or 2 funds?
Right. So I think, Neeraj, like you rightly said, investors are looking at, having exhausted the usual large, cap schemes, which used to be the favorites, are looking at mid and small as well. As advisors, we also do suggest some allocation to mid as well as small, of course, keeping valuations in mind. And I think with that thought in mind, one would think, the DSP mid cap to be one of the, strong suggestions that we do have in our current research universe. And I think one of the reasons why, as we look at schemes more and more, we do give enough weightage to both qualitative as well as quantitative parameters. Usually, of course, from investors who do their own research, there's a lot of more weightage given on, the returns, etc. I think there are also some advantage that this scheme does bring because of a very long fund manager history. in the fund manager who manages this fund. I think he's been with the fund since 2012, if I'm not mistaken. So that bit of strategy that he or she brings to the table also has some merit, which kind of shows over time in DSP midcap. That's one. Another, of course, as we have been reading about the scheme because of our research process, we understand that there is a very good process of stock selection that they have arrived at. I think in the midcap space, they have figured that how they can identify companies with a good amount of competitive advantage, which leads to maybe them gaining a certain kind of market share and therefore pricing power and so on. And that kind of obviously shows in the stock price and therefore obviously in the NAV of the scheme. And the third is that this stock selection is not necessarily just buying at any price as well. Because when we look at the P of DSP midcap, what we find if we compare it to like a peer group, or if we compare it to the Nifty P and so on, what we find is that it's fairly reasonable. So when an investor is looking at a mid-cap scheme with a reasonable PE, one is actually saying that, okay, I'm buying this, but I'm not buying it expensive in that sense. So I have a fair amount of predictability or a probability of, some kind of good returns from where I'm buying at. So I think buying into whether it's a mid or a small or any kind of scheme, like we talk about index schemes as well. I think the valuation of the scheme, some bit of thought or reading around that also does help in the selection. So that's been one of our choices. If you'd like me to add, I think we have
Sure.
Axis Midcap also being very close contender to DSP. I think Axis has been a scheme which has been almost like about 10 years now in existence. So again, they have a fair amount of assets very close to what DSP manages in terms of, if you talk about investor confidence given to the scheme in terms of asset size. And they have, when we look at returns, and we don't look at just trailing returns or just past so many years, but we look at returns on a more rolling basis, we understand that this has been a fairly good, consistent performer, so much so that they have been very high double-digit kind of returns in the 3 and the 5 year horizon also. So that, I think, brings a lot of confidence when one suggests that as a scheme to an investor. So that, and of course, they have a certain bit of being in the mid-cap space. They do have certain bit of orientation on how they can cap the drawdowns, because mid-cap schemes do tend to be more volatile, but they have been able to, with the selection or with the way the scheme composition is, they've been able to cap the drawdowns when a market is bearish or a market has seen, like the last March 2020 when the market saw a lot of fall. These instances do allow us to understand that the drawdowns have been fairly capped in that sense, limited drawdowns. So that also allows us to understand that it could be a mid-cap scheme which will show less volatility. So that also is something that allows us to suggest that to investors. So
okay, well, no, this helps certainly. Thank you so much. I'm sure investors have a lot of takeaways from this. Shalini, always a pleasure having you. Thank you so much for joining in today.
Thanks
Stay
for having
safe.
Thank you. Take care.
The pleasure was ours. And viewers, thanks for tuning into this leg of the Mutual Fund Show.